75% of pre-pandemic levels, compared with just over 60% during the week, which is interesting. So riders on some New York City subway lines may see less service on Mondays and Fridays and an increase on weekends. But of course, these are proposed changes, but if they are approved by the MTA's board, they would begin in June, Scarlett.
In June, when the weather gets nicer, I would probably walk from Grand Central to the office. But this, I mean, I feel like if there are going to be fewer cars on Mondays and Fridays, fewer subway trains, that is, that will discourage people from coming in on Mondays and Fridays. They'll kind of cement this change in the work schedule that everyone has gotten used to, and a lot of companies are pushing back on.
Well, that's the thing. It's like chicken and egg, because I mean, walking around the hallways of Bloomberg on a Friday, especially
Friday afternoon,
there's no one
ghost
here.
Town.
There's no one here. Total ghost town. It's just me and Scarlett holding down the fort. So it makes sense that the MTA would want to cut back here. And the article that we're looking at does say that these changes would save the agency an estimated $1.5 million. Although the changes are meant to better match subway usage rather than find cost savings. But $1.5 million.
If they want to do cost savings, they've got to think bigger than that. And by the way, this would be for reduced subway service on the 1, 6, 7, E, F, L, and Q lines on Mondays and Fridays. And these changes would mean riders are estimated to wait only an additional 3 to 30 seconds on those days.
I don't have 30 seconds, Scarlett. I take the 6. I don't have that kind of time.
I also don't think it's going to be just 30 seconds. I've often waited on the platform and seen the sign that says it's going to be another 7 minutes before the train comes.
Yeah, not something that you love to see. But in any case, again, they're proposed changes, so we'll see if they happen. We have some cross-platform coverage coming up with our Bloomberg television colleagues. That's next. This is Bloomberg.
To last week of 2022. We are moving closer to the closing bell for market coverage right here on Bloomberg as we take you to the bell and beyond.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
About 2 minutes away from the end of the trading day, I'm Kaylee Lyons with Shonali Bosick, counting you down to the closing bell, and here to help us take things to beyond the bell with a global simulcast. We're joined by Katie Greifeld and Scarlett Fu, bringing together our Bloomberg television, radio, and YouTube audiences worldwide to parse through the most crucial moments of the trading day. And what a trading day it has been. We're just off of session lows, but still could be the 4th down day we're looking at here for U.S. stocks, Katie.
We are off of session lows. The S&P 500 is down as much as 1.4%. Earlier, we've seen a little bit of a bid just in the last couple of minutes or so. Kaylee, I know usually, hopefully, you're not paying attention at 4 p.m. since I believe usually you're on at 5 a.m. But things can get pretty funky in the last half-hour trading, and maybe we're seeing a little bit of that, Scarlett.
I think what's actually happening, and we're going to see this for a while to come, is the repricing of growth. And we're talking to Dryden Pence, the CIO at Pence Wealth Management, and he says this can take several months. We'll see a bumpy first quarter, but right now you're also getting some tax loss harvesting and some loss minimalization. So there's a lot of moving parts with people waiting for a Santa Claus rally, and as they do that, they're looking to close out their portfolios or at least make it look not as bad, or perhaps take advantage of some losses to reduce their overall tax bill.
Oh, so exciting to talk about taxes, Scarlett, but really, well, we talk about the end of the day as well. You know, it really has been about another very exciting story here. Yields, and more yields. You have to wonder when the stuff that's happening in Washington will also start to add on to that tightness that the monetary conditions have been adding on as well.
Well, Shonali, as you say, it's all about yields, and that is why we have seen the NASDAQ, those tech-heavy, high-multiple stocks, underperforming on the day. As we hear those closing bells ring, that index down by about 1.5%. Not the steepest losses we had seen in the session, but steep nonetheless, especially so compared to the Dow, which is down only about 0.5%. The broader S&P 500 down about 0.9%, 318.17, where we close today, Katie.
Pretty
oh my
broad.
Goodness.
You know,
Too
I
many
get that
names.
all
Kaylee,
the time.
Katie,
I've been called worse, but in any case, it is a pretty broad-based sell-off. You have 392 names in the S&P 500 lower, just 109 names in the green. So again, not too pretty out there on the S&P 500 at least.
No kidding. Take a look at all of this red on the screen. You have consumer, media, retailing, semis, all down more than 2% on the day. You have a little bit of green, guys. I will point out the green because those banks, they're up a whole 0.3% on the day. We've been talking about that yield story, but food and beverage and energy are also seeing a little bit of a boost on the day. But again, mostly here in the red. Let's hope tomorrow's a better day.
Well, it was energy and it was banks. You can see that on the single stock level as well. I did find some gainers. We have energy up there. Again, energy, one of the best performers today. Looking for a little bit of a fundamental story here. There is a headline on the terminal that insiders at this company bought more than $1.47 million worth of shares. Maybe that's helping give a little bit of a bid in addition to some higher commodity prices as well. Moving down, we have Wells Fargo. Actually, this was the second best performer in the S&P 500 after energy. We did have, yield curves a little bit steeper today, still very deeply inverted. This was the outperformer among the big banks, up about 1.5%. Wells Fargo only down 13% this year. So big outperformer relative to the S&P 500, even with those losses. And I did want to end on a little bit of an outperformer, you could say. This is Madrigal. It had its late-stage clinical study of a therapy for liver disease meet its main goals that earned an upgrade at Raymond James. And you can see the stock just absolutely skyrocketed up 268%, Scarlett.
Yeah, the lottery ticket for whoever might have been invested in that one. It was an embarrassment of riches in terms of looking for decliners. I'm going to start big with Amazon because Evercore cut its price target to $150 on signs of cloud softness, which is unusual given that Amazon Web Services has been such a source of strength for the company. Disney was the biggest decliner in the Dow to make a new 5-week low. The opening weekend of the Avatar sequel came in way below box office estimates. And we're going to end with an ETF, XHB, which tracks the home builders along with companies that support the industry. Home builder sentiment came in and it extended its record decline to 12 months. It's now at its lowest since June 2012, if you exclude the really funky period right after COVID began. Of course, Kaylee, we get November housing starts and building permits tomorrow, which may just kind of reinforce the bad news in the home building market right now.
Yeah, housing really where you're seeing the softness come through as the Federal Reserve has raised interest rates aggressively this year. And of course, the anticipation that they have more to do is what really is leading a sell-off in bonds today. Everything related to the equity story honestly comes back to the bond market story because that is what drove so much of the action. The 10-year yield up 10 basis points on the day, 358 where it trades at the moment. That is about 67 basis points below that of the 2-year Treasury yield, which rose 8 basis points today to 425. So still a very deeply inverted yield curve, even if we aren't at the depths of inversion we were earlier this month. But what that inverted curve, Katie, is signaling is real concern out there about growth, about the idea that the Fed is going to tighten too much, choke off the U.S. economy, and as a result, there's going to be a lot more pain to come for assets across the board.
Yeah, the magnitude of this inversion you really can't ignore. Interesting to see a bit of a bear steepening today on the yield curve, especially a lot of that selling coming in the 10-year Treasury yield specifically. But still, we're below 3.6%. You think about where we were just a few months ago, about 4.3%. We've still seen a pretty big bond rally here over the last few months.
And that's why people like the bond market. That's why they say there is an alternative in the market now, whereas for so long in the zero interest rate environment, no one wanted to be in bonds because you needed yield. Now you can look at it and actually get something good. Still, within equities, you're looking at, I feel like crowded trades. We go over this all the time. Who are the best performers? You've got staples, you've got energy, you've got financials, because these are the companies that have a chance to eke out margins or maintain their margins in a recessionary environment. We don't know whether it's going to be a long recession, a short recession, a deep recession, but if you had to pick, you're going to go with what you think is going to be safe.
Okay, I'm going to give you a hot take here on crowded trades for a second, because normally we think crowded trades too crowded. Maybe those are the ones to watch, but with how well trend followers have done this year, you have to wonder whether you like to follow the crowd. The trends have been getting, if you listen to Cliff Asness, more extreme on one end or another, and there is some banking research out there today that says that might continue into next year.
All right, hot take from Shonali
Hot
Bostic.
take.
I don't know if I have a hot take that can follow that, but maybe something that is going to be hot this week, Katie. I'm looking for anything because I thought the week ended, or the year ended really last week when we got all of those central bank decisions. I thought we could all pack up and go home. Obviously, the four of us are still here.
You have to stay with me.
I do have to hang out with Shonali. This is true. But there are some things we're going to be here talking about this week. A lot of economic data rolling out over the course of the next couple of days, and we know the Federal Reserve is going to have an eye on that.
We do have PCE. That seems to be the headline, at least for me. That's on Friday. That's what I'm most excited before, since I'm off all next week. So when we finally get those numbers,
humble brag.
I can go home. But we also have earnings, too. Nike, for example, FedEx, earnings season never ends, not even in the second to last week of December. And of course, it'll be an important read on the health of the consumer at this moment.
Yeah, big questions about how much Nike may need to cut prices, promotional activity, just to get the sales numbers up, but at the cost to profit margins, especially when you think about the strong dollar as well, since Nike is a global brand and certainly relies on those Asia-Pacific and European markets.
Yeah, we talk so much about yields. We have to talk about that strong dollar and whether that trade actually starts to come off in a bigger way come into next year, and what would drive that for us forward.
Yeah, have we seen the peak already? Peak dollar, peak yields, peak hawkishness of the Federal Reserve. It seems we always come back to these questions, Scarlett. Time and again, we realize that we had not actually seen the peak, but maybe it's in now, and I say that with a giant question mark attached to the end.
Yeah, no, you're absolutely right. BlackRock, for instance, is betting that these estimates of peak inflation are just flat out wrong. Inflation may be slowing, but it's not going away anytime soon, and certainly not coming anywhere close to the Fed's 2% target. So you have to perhaps readjust your expectations and not look for things to go back to the way it was anytime soon.
I got to say, so much of the inflation conversation depends, though, on what commodities are doing, what oil is doing. And I want to point out that for the second year in a row, energy is just absolutely crushing it. That sector is up 52%. It is the only sector higher this year, and it was the outperformer last year, too. So you talk about a crowded trade. You have to wonder how much juice is left in energy.
And people love it, though. They still have it as one of their best performing sectors in the year to come. I mean, all the different notes that we've gotten on the 2023 outlook, highest yielding sector still provides a lot of value, even with all those superlatives you just gave us.
Yeah, and I wonder how much China is the reason why, because in theory, that's going to drive a lot of demand, continued demand on the commodity complex, and keep pushing up those profits for energy companies higher, Chanel.
I'm going to be so boring, though. I know that the energy story is a huge story, especially
Cold take coming.
Cold take. It is cold. It's appropriate for the season. But, you know, the housing market, we have to keep on watching. We have to keep watching closely. And tomorrow it starts. It's a good start. Good start.
All right, it's housing, it's energy. We have a lot to keep an eye on in addition to the economic data, to the earnings. We're going to do that all week, but we have to say goodbye for now. That does it for Beyond the Bell. It's our cross-platform coverage of the market's close on Bloomberg Television and Radio and YouTube. Also now streaming on Bloomberg Quick Take. We'll be back tomorrow, same time, same place.
Money will travel, have time will travel, but Katie, are there any travel deals to be had?
It's a great question. Luckily, my husband has been booking everything, so I couldn't tell you, but
he'll know the answer to that.
Yeah, we'll get him on here tomorrow.
Okay, well, in the meantime, let us check in with Steve Hafner. He is CEO of Kayak, to tell us what he sees out there. Steve, give us a read of what you're seeing. Are there a lot of people looking, searching for last-minute deals?
Absolutely. Travel interest, consumer travel interest in getting out and away is stronger than ever. So at Kayak, domestic queries are up 25% versus last year. International queries are up even more, 74%. People, despite the headlines, the macro trends, seem very eager to get out and away. And that's reflected in prices, by the way. The average domestic airfare is $500 right now. And if you want to leave our borders, the average international airfare is almost $1,000.
Well, we live in the macro, and all we talk about is inflation, is a recession coming, and like you said, you're not really seeing that reflected. And I want to talk about the psychology of that. Is that revenge traveling? Is that just extreme pent-up demand?
Yeah, I mean, we're not seeing it yet. But you have to remember with the travel business, we had 2 years of basically no travel, and that was all collapsed into 6 months of travel in 2022. And I think most of the revenge travel is done by now. People are just remembering how great travel is, and they're looking forward toward the next trip. So I think that's what's going on. I suspect prices will stabilize a little bit going into 2023. At least I hope they do. But we don't see any slowdown in consumer interest in travel.
I want to pick up on something you mentioned, which is international flight searches are up 64% year on year. How much of that do you think is due to the strong dollar and people realizing that if they go somewhere else, they can take advantage of their dollar because at home, and I mean, obviously this is a case globally, inflation is such a scourge and it's really limiting what we can spend out there. But if you go to Europe, then, there's a discount. If you go to Japan, there's a discount. And if you're going to spend the time and the money to take a break and go somewhere, better to go somewhere where your dollar gets you further.
It definitely goes a lot further abroad than it usually does, especially in Europe. But the problem is you still got to get there first. And, international airfares, like I mentioned, are almost $1,000 round trip in economy to get there. So it's still very expensive. I will say that the highest trending destinations aren't in Europe. They're actually in Asia Pacific, because you've got a bunch of countries there that have been closed for the last 2 to 3 years. So I'm talking about Vietnam is the top on our list, up 700%, Australia, Thailand, even Japan.
So I know that during the pandemic and right afterwards, there were a lot of flights that were cut. And so the supply of these flights were limited. Have we seen supply come back up to meet that increased demand?
It's coming back, but it's still below where it was in 2019. So if you look at TSA passenger counts now, we're almost back to 2019 levels, which is pretty impressive because the airlines themselves have about 8% fewer seats to fly. So, if you've been flying, you'll notice the planes are full. And that's also what's being reflected in the airfares.
And I know we're talking about holiday travel and the fun type of travel, but let's talk about business travel for a little bit. Are we seeing any sort of rebound there?
Business travel is definitely back, not in terms of total passenger count, but in terms of revenue because of these average fares. What's different about it, though, versus pre-pandemic is the day trip, the whole notion of flying somewhere to see a client and being home in your own bed at night is essentially gone. So it's just way too convenient for that. Plus, a lot of companies allow their employees to tack on a day or two on either side. So what we're seeing is a lot more 2 to 3 day trips than single day trips. And then the second trend that's a little bit different these days with business travel is it's not all about visiting clients. Now a lot of companies are trying to get their employees together, so we're seeing a lot more offsites and fun destinations.
So that must mean that the kinds of flight routes that the airlines are offering has to reflect that. Perhaps people are not flying into San Francisco anymore to the same extent because they can Zoom. Certainly we know that all these people who are in the Bay Area are working from home. So they're fine with doing the technology and meeting that way. But if companies are sponsoring their employees to go on an offsite, it might be to New Mexico as opposed to San Francisco.
That's right. So the last 3 kayak offsites, for example, have been in Dubai, in Mexico, and in Iceland.
I want to work at Kayak.
That sounds great. Let's talk, though. I mean, I'm still stuck on the macro since that's all we do at Bloomberg. And you do write in your notes that if you look at domestic flight searches, prices are up 52%. Internationally, prices up 29%. And obviously, the consumer is resilient. We're seeing that in all parts of the economy. But at what point, if you look at past inflationary periods, and to be fair, there haven't been a ton of them in the past 2 decades or so, but at what point do we start to see maybe a little bit of that demand destruction in the face of higher prices?
Well, look, I would hope demand softens a bit because that will absolutely put a little bit more downward pressure on prices. But I think it's actually input costs that need to soften first. So fuel is a big cost center for the airlines. That's got to come down. Staffing costs has got to come down. And then the big airlines have ordered much more fuel efficient planes. So if United can get its hands on 100 more Dreamliners from Boeing, that'll help a lot with their actual unit economics.
Is there going to be a quiet period, a lull in terms of travel coming up anytime soon? Or has our post-COVID travel habits changed all of that, changed what we're familiar with, where, maybe mid-January is a really quiet period, but that's no longer the case?
We haven't seen that in the numbers. So it used to be historically you see these peaks and valleys, but what the airlines would try to do is cut airfares to maintain occupancy on their planes, and hotels would do the same thing with their rates. But we're seeing no evidence of any price softness, which tells you that demand is still pretty strong throughout all these periods. And I think the pandemic gave consumers a lot of flexibility, particularly since you don't have to go into the office every day, as you mentioned in San Francisco in particular. So that means that they're exercising the desire to fly in atypical time periods. And I think that's good for the industry, and that's actually good for consumers too.
And let's unpack some of this demand. Where are people actually looking to go, especially on an international level? Where are they trying to fly to?
It's the usual suspects, the big cities. So Paris, London, et cetera, in Europe. And then, as I mentioned, APAC is a big draw in terms of being trendy right now, because, your average American hasn't been to Australia in 3 years, right? Because you had to quarantine when you got there for an extended period of time at your cost. So for those folks who have connections in APAC and Japan or Thailand, et cetera, now's the time to go, and they're voting with their feet.
Steve, is there anything you're excited about when it comes to innovation in travel, something that you're looking ahead to that could really change how these companies are responding to this increased demand?
Absolutely. Look, at Kayak, we've been innovating this space for almost 20 years. So the thing that I'm really interested in these days is how can we make the security line and the check-in much more efficient than it is today? Because we simply don't have the staff and the human resources to handle the volume of consumers coming through airports right now and onto planes. So you would hope that identity facial recognition can make the whole process a lot more efficient. And I think that's coming. So if you've ever had the experience of boarding a Delta flight internationally, where they just scan your face when you board, it's pretty darn cool and also very, very efficient.
Also kind of scary.
That is scary. I don't want to think about that one too deeply. But Steve, 20 seconds. Are you traveling this holiday?
I am not. I actually live in Miami, and I'm up in Stanford for the cold weather for the next 3 weeks. And then, once the dust settles on January's in the rearview mirror, then I'll go down to St. Bart's.
All right, so I think you're the opposite of the snowbird if you're traveling from Florida to the snowy place. Really interesting to get some time with you. That is Steve Hafner. He is co-founder and CEO of Kayak. He joins us on Zoom from Stamford, Connecticut to break down the holiday travel trends. We have much more Bloomberg Business Week coming up. You're listening to Bloomberg Radio.
facts, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
The equity market was on the back foot for the entire day as the market prepared for the likelihood of recession. Fed officials seem intent on raising interest rates until they are very confident that inflation has been subdued. And the market expects that economic contraction will be the inevitable outcome of all of this. So the debate, I guess you could say, is now over the depth and the duration of recession. We know that many rate-sensitive areas of the economy have been hurting for months. Today, we learned that U.S. homebuilder sentiment was down in December to the lowest level since June 2012, that excluding the onset of the pandemic. And today we had yields, curiously, up across the curve, which probably reflects more about what the Fed plans to do than the inevitability of recession. The 10-year Treasury up in yield to nearly 3.60%. We were up just about 11 basis points on the day. A 2-year at 4.26, higher in yield terms by about 9 basis points. Shares in Twitter were whipsawed through the day. This is after Elon Musk suggested he may be stepping back from running the company. It was yesterday, Musk conducted a poll. It asked, hey, should I step down as CEO? About 58% of those respondents said yes. Today, analysts over at Oppenheimer expressed concern about Twitter-related risk for Tesla. Shares in Tesla today finished down just 0.2%. Dow Industrial Average off 0.5%. The S&P today losing about 0.9%. NASDAQ comp drops 1.5% today. I'm Doug Krisner. That's your Bloomberg Business Flash.
All right, thank you so much, Doug Krisner. Well, there's literally 6 shopping days until Christmas. Super Saturday, I just learned what this is. It's when the procrastinators hit the stores to lock down last-minute deals. So what kind of spending took place? Let's get into it with Tom McGee. He is president of ICSC. He's here now. He's joining us on the phone from Basking Ridge, New Jersey, to give us the holiday spending outlook for retail. Tom, it's great to have you with us on December 19th. When you think about what we saw on Black Friday, on Cyber Monday, and now on Super Saturday, how do we look heading into the last few days before Christmas?
I think we look solid. First of all, thanks for having me on. I think we look solid. Our expectation going into the holiday season was that holiday sales would increase 6.7% year over year. We believe we stand behind that. We think it might be a little bit better than that. Over Super Saturday, which is this last weekend, there were 189 million people that shopped. About 50% of shoppers entered the weekend and not yet done with their holiday shopping. I would expect that over the course of the next couple of days, there's a whole lot of additional people that still aren't done with their shopping. So I think you will see the stores crowded for the next number of days leading into Christmas Eve.
I remember when Thanksgiving happened and we were talking about what the holiday shopping season looked like at the beginning. There was a lot of talk about how the consumer is going to wait until the end because on the hope that there would be more deals. Do we have any evidence that there are more deals now as we get to the last few days?
I think there are in increasing levels of promotion. Just to take a step back, I think this was a very long holiday shopping season. It really started in October. That's been a trend over the course of the last couple of years, but particularly this year, the season was longer. People were concerned about inflation, and so I think they began shopping earlier on fears of higher prices, and then took advantage of any promotions that were out there. And so that's why you saw a very strong October. I do think that's one of the reasons why perhaps November wasn't as strong as we had hoped. But I think December will be strong. I think there is still a lot of pent-up demand. The consumer has been resilient, although very concerned about inflation. 9 out of 10 Americans that we polled said inflation is their number one concern. But the consumer has been resilient. I do expect December sales, and particularly sales over the last 2 weeks heading into Christmas, to be quite strong.
So 9 out of 10 shoppers concerned about inflation said that inflation impacted their shopping. How did that manifest? Does that just mean that they were, again, on the lookout for those deals, or were they spending less overall? What did that actually look like?
I think it's a little bit of all of those things. I think it's one, very much looking for promotions and deals. Two, perhaps being more conscious on the products that they select, and three, where they shop. There's certainly an increased level of traffic in discount department stores, discount retailers. The Walmarts, the Targets of the world. So I think that has been increasing the level of traffic in those stores, and perhaps not as much growth in luxury over the course of the last couple of weeks.
What about inventory? What do we know about whether there's enough product for consumers who are now, waiting for those deals and really looking to maximize their efficiency the last couple of days here? If they go to the store, will they find it, or are the store shelves bare?
Yeah, I think inventory levels are strong. There clearly last year there were significant concerns around supply chain, and there are sporadic issues around the supply chain, but not to the extent of last year. So generally speaking, if you're going to the store in the absence of some particular product or color that's particularly hot, I think you're going to find what you're looking for, and perhaps again going into with a little bit of softness in consumer demand, you might see some more promotions than you saw last year. Certainly the level of promotions this year are greater than last year.
So the imagery of shelves and bare shelves, it's very evocative, but how many people are actually going into the store? When we talk about holiday shopping, walk us through the breakdown between how much of it is happening in real life versus people shopping online.
Well, I think, the vast majority of sales still happen in the store. 78% of U.S. adults over the Thanksgiving weekend went to a store to shop. Certainly a high percentage of people shopped online as well. Retailers, quite frankly, they need to be very effective in both the digital and the physical channel. And you're seeing an increasing level of agnostic behavior among retailers in regards to whether you buy online or in the store. In many respects, the store is serving as both the vehicle for a traditional shopping experience, but also a mini fulfillment center. The level of growth in buy online and pick up in store, curbside pickup, is significant year over year, and that is really one of the stories of the pandemic. And you're starting to see a real change in the physical layout of stores to accommodate that consumer behavior. So the rebirth of physical retail since the pandemic has been quite strong. Vacancy levels are at all-time lows. And I really think that the story of the pandemic was really the convergence of the physical and digital world. And it's been quite pleasant to see the increase in enthusiasm for physical shopping since the pandemic.
Well, one of the stories of the pandemic was also a switch from the experiential back to the physical. Now that the economy has opened up and there's a lot of pent-up demand for people to go abroad and to go out and do things again, what do we know about the propensity and the demand for physical gifts as opposed to experiences? Have we seen the pendulum swing back to people wanting to spend money on going out to dinner, seeing a show, and experiencing something with their families and their loved ones as opposed to having an item that can be gift wrapped?
Yeah, I think the vast majority of gifts will still be physical gifts, but there is an increase in experiential. Matter of fact, one of our findings going into the holiday season was an expectation that restaurant dining would significantly increase over the holiday season, and we've seen that bear out. So our expectation was that dining would increase by 10% over the holiday season. And if you think about it, that kind of makes sense. This is really the first holiday season since the pandemic where we've kind of gotten close to pre-pandemic behavior, and so you've seen the reemergence of holiday dinners, corporate outings, family gatherings, et cetera, in restaurants as they did pre-pandemic. So a significant level of growth in food and beverage over the holiday season.
Yeah, I quickly realized during the pandemic that one of my main hobbies is just going to a restaurant and eating in it. So I'm happy to say that I've resumed doing that. But Tom, like you said, it's been a long holiday shopping season. It's been a long year, in fact, but The fact that we have seen really the holiday season start in October, how unusual is that, and what's the cause behind that? Why did we start early this year?
Well, I think inflation had a big part in that, and I think a little bit of some of the lessons we learned from last year. You know, the supply chain concerns of last year really led to a lengthening of the holiday season as well, as people wanted to get ahead and concerned around supply chain issues, and so that behavior kind of continued into this year. And as people were price conscious and concerned around inflation, as promotions took place in October, and just the concern of accelerating pricing. People really leaned in October. I think that you did see some sales that would have normally happened in November get pulled forward into October, which could have explained some of the decline in month-over-month sales from October to November. But year-over-year, November was still quite strong. I mean, 6.5% year-over-year in November, but that was less obviously than October. So I think there's a lot of factors that have played into that. I think December will be strong, not dismissing the concern around inflation.
Yeah.
There's just a lot of folks that do wait till the latter half of December to go shopping, and that's also part of a typical consumer behavior.
See, a lot of things are turning back to normal. Procrastinators unite. Tom McGee, thank you so much, President and CEO of ICSC. Katie, are you a procrastinator?
Oh, big time. I have not started shopping. 6 days.
Yep, you can get it done. Let's get a check on the latest world and national news with Denise Pellegrini in the Bloomberg 1130 newsroom. Hi, Denise.
Yes, Scarlett, things are getting back to normal for me too, which means procrastinating. I just started yesterday. Don't tell the kids. One thing that didn't procrastinate, though, is that House January 6th committee, they are recommending that former President Trump should face criminal charges for his role in the January 6th Capitol Hill insurrection. And the committee making that recommendation to the Justice Department. We get more from Bloomberg's Irv Chapman.
Members outlined the evidence. Representative Zoe Lofgren.
Donald Trump knowingly and corruptly repeated election fraud lies, which incited his supporters to violence.
Vice Chair Liz Cheney described Trump watching the riot he sparked on television.
He would not issue a public statement instructing his supporters to disperse and leave the Capitol, a clear dereliction of duty.
Chairman Benny Thompson.
Accountability can only be found in the criminal justice system.
The committee also said Trump raised money that paid a lawyer who offered a lucrative job to a witness in return for not remembering incriminating testimony. In Washington, Irv Chapman, Bloomberg Radio.
All right, thank you, Irv. As the crypto crisis on FTX unfolds, word coming in now that FTX co-founder Sam Bankman-Fried is back in a Bahamian prison this hour. That's after a hearing that was supposed to focus on his extradition. It did not after he consulted with his lawyers. He did not waive his right to object to an extradition. And this means if he maintains his right to fight extradition, he would have a hearing on the issue in February. And this fall's trifecta of respiratory illnesses, flu, COVID, RSV, well, that has reduced the national availability of pain and fever medicines, especially for children. So now the nation's two largest drugstore chains are putting limits on those purchases. Customers are being limited to what they buy at CVS and Walgreens when it comes to kids' painkiller. I'm Denise Pellegrini, and this is Bloomberg.
Headlines and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
The Fed seems like a dog with the bone, and officials have been relentless in vowing to keep raising rates until they are confident inflation has been subdued. So let's say recession is inevitable. Maybe the debate now is over the depth and duration. The Treasury market, though, today, curiously, seemed to be more focused on aggression rather than the outcome, which we are assuming would be economic contraction, right? We had yields moving up across the curve today. The policy-sensitive two-year jumping nearly 8 basis points to 425. At the longer end of the curve, the 10-year was up more than 10 basis points to 358. But for the equity market, I think the primary concern is earnings recession. You can make the case that much of that has already been discounted. Today we heard from Morgan Stanley strategist Mike Wilson. He said this earnings recession could be very similar to what we saw in the period 2008-2009, and that maybe could spark a new low for the equity market. Stocks were down today, yes, but we finished off the worst levels. Dow today down about 0.5%. The S&P fell 0.9%, and the NASDAQ comp was down about 1.5% today. Tesla shares were whipsawed throughout the day after Elon Musk suggested he may step back from running Twitter. Analysts at Oppenheimer remain concerned about Twitter-related risk for Tesla. At the low point of the day, Tesla shares were down nearly 3%. At the high point, they were up more than 3%. Tesla ends the day down just about 0.2%. I'm Doug Krisner, and that is your Bloomberg Business Flash.
All right, thank you so much, Doug Krisner. I'm Katie Greifeld alongside Scarlett Fu. We're filling in for Carol Masser and Tim Stenovic on Bloomberg Business Week Radio. Bloomberg Business Week is brought to you by SEI, with an operating platform designed to support all major asset classes, diverse strategies, and investment vehicles. SEI is redefining wealth management. Learn more at seic.com/tech.
It has been a terrible, horrible, no good, very bad year for big tech. And for anyone who is looking for a turnaround next year, they might need to be extra patient because of plenty of macro headwinds out there, as well as just a concern that these stocks are overpriced. So let's check in with Baird technology strategist Ted Mortensen for his 2023 tech stock outlook. Ted, welcome to Bloomberg Business Week.
Yeah, thanks for having me.
So we've heard a lot of these companies announce layoffs. They are cutting costs. They are they're right-sizing their businesses for higher interest rates, for slowdowns. Give us your broad overview for what kind of tech companies are best positioned and worst positioned.
So I think this cycle is going to be emblematic that the platforms win. The best of breed companies that may be point solutions will struggle in this market just because these digital transformation macros are so massive and they really require scale. So the companies that are going to do really well in 23 and 24 are the companies that do play into these massive digital transformation macros. They haven't changed a bit. The valuations have come down. But cloud AI, security, 5G, IoT connectivity are still very much in place. And I think when you look at the platform companies, not only do they have the scale from the P&L standpoint, sales and marketing, R&D, but they free cash flow very, very well. And that's going to get them through this downturn that we're experiencing with every central bank tightening.
With every central bank tightening, that leads nicely to my question, which is the re-rating that we've seen in technology. Is that just, again, that these stocks got maybe overvalued, maybe too expensive, or is there something fundamental going on with the broader sector outside of some of the heavy hitters?
It's really fundamental with the models going forward, and you asked the right question. You have to get right now into the model. And the 2023 models are too high. And I think the street understands that they're too high. But everybody's waiting for the February timeframe when we go through Q4 earnings season to see what these managements say. And, you know, the best thing that could happen, quite frankly, is these managements basically capitulate and saying, we're taking our 23 estimates down and we're baselining 23 and 24 based upon the macro. and they take the models down to something that's actually believable with the buy side. The companies that are going to say, in my humble opinion, we haven't seen it yet, they're the ones that are going to get punished. So, number one, the 23 models are wrong, I think, to where they are right now. So, whether it be the first call estimates or just generally where people are in semi software and other sectors, we maybe have not reduced the earnings enough or the revenues enough, and that's very, very important as it relates to price to EV ratios in software or just earnings as it relates to the broader tech tape.
Wow, it's going to be a grim February then, if you're suggesting that companies rip the Band-Aid off, because people are not quite there yet, as we see every day in the trading. What about IT spending in the cloud? Because for so long, that's been a reliable source of revenue and earnings for the tech sector at large, that there's so much upgrading of companies' systems and the cloud is a consistent way to invest in your infrastructure, that it's not going to go away anytime soon.
It's just the rate of change is changing. If you look at 21, where we still had a very loose monetary policy kind of in the front half of the year, the cloud CapEx was running 30% plus. And the Global 2000 has to move here or they risk their businesses. The US has moved to this next generation cloud architecture. But as you look at estimates in late 22 and into 23, unfortunately, the rate of change of, with 30% growth rate and the Fed and QT taking out liquidity, it's almost impossible to keep up that growth rate. So from a standpoint of mere arithmetic, the second derivative is down. That doesn't mean, quite frankly, that these macros are falling apart. In fact, I think they're strengthening, because the only way you can compete in the new world is moving to the cloud, moving to AI, and quite frankly, gaining more intelligence on your data. So the only other arcing input that people were kind of worried about in 23, with all the digital transformation macros still in place, the US seems to be the best neighborhood. But if you look at what's happening on checks coming out of the Far East or even Europe in general, you need to have all cylinders, the engine firing, and we just don't have it right now from a macroeconomic standpoint.
And Ted, I want to step back because I'm hoping you can put this moment in context for us, because I've heard this tech wreck, if you will, that we've seen over the past year or so compared often to what we saw in the early 2000s. And you look at the NASDAQ 100 right now, down about 32% year to date. You look at what happened in the year 2000, that index was down almost 37% and then went on to fall more than 30% the next 2 years as well. So again, a lot of size and scopes there, a lot of comparisons to 2000. We only have about a minute left, but do you see those parallels as well, or is that an exaggeration?
There are some parallels, very specifically on the private side. I mean, we haven't taken our medicine on valuations yet, on mark to market, and that'll happen in Q4. That's one that's very similar to 2000. And quite frankly, I'm old. I lived through it, and boy, did I lose some body parts. So from a cyclical standpoint, there are very many similarities, whether it be valuations, whether it be private valuations, public valuations. But I think this cycle's a little bit different, just because you are fighting multiple Feds at this point, multiple central banks. And quite frankly, that's going to rearrange the deck chairs a little bit. Again, platform companies are going to win. Point solutions are going to get consolidated.
Ted Mortensen, he is technology strategist at Baird. He joins us on Zoom from Tampa, Florida. Really appreciate your insight at this moment in time. Again, after a brutal year for technology stocks, the NASDAQ 100 down 32% year to date, down another 1.4% so far today. We'll see how the rest of the year goes.
It is 4:53 on Wall Street. I'm Doug Krisner at Bloomberg World Headquarters in New York with a look at what is making some news in terms of company headlines today. We had shares in Digital World falling by more than 11% today. Digital World is the SPAC for Truth Social. This is the social media site started by former President Trump. Earlier today, we've been talking about the January 6th committee laying out an ambitious roadmap for the prosecution of the former president and several of his allies. Shares in Tesla were whipsawed through the day. This is after Elon Musk suggested he may be stepping back from running the company. Yesterday, Musk conducted a poll asking if he should step down. About 58% of respondents said yes. And today, analysts over at Oppenheimer remain concerned about Twitter-related risk for Tesla. We had shares in Disney falling to their lowest level since March 2020 after a tepid weekend debut of the film Avatar. This is Avatar: The Way of Water. Disney lowered guidance for the film's opening over the weekend. Epic Games will pay $520 million in fines and consumer refunds. This is part of an agreement with the Federal Trade Commission for violating a children's privacy law and tricking consumers into making purchases. Epic is the developer of the game Fortnite. The video game has more than 400 million users worldwide. Those are some of the stories we're following. I'm Doug Krisner, and this is Bloomberg.
This is Bloomberg Business Week with Carol Messer and Tim Stenevec on Bloomberg Radio.
All right, let's get a check on the latest world and national news with Denise Pellegrini in the Bloomberg 1130 newsroom. Hi, Denise.
Hey there, Katie. Thank you. And as we've been reporting, the House Select Committee investigating the January 6th Capitol riot saying unanimously that former President Trump should face criminal charges for his role in the January 6th Capitol Hill insurrection, and the committee making that recommendation to the Justice Department. And we have more on what went down now from Bloomberg's Irv Chapman.
Members outlined the evidence. Representative Zoe Lofgren.
Donald Trump knowingly and corruptly repeated election fraud lies, which incited his supporters to violence.
Vice Chair Liz Cheney described Trump watching the riot he sparked on television.
He would not issue a public statement instructing his supporters to disperse and leave the Capitol. A clear dereliction of duty.
Chairman Benny Thompson.
Accountability can only be found in the criminal justice system.
The committee also said Trump raised money that paid a lawyer who offered a lucrative job to a witness in return for not remembering incriminating testimony. In Washington, Irv Chapman, Bloomberg Radio.
All right, thank you, Irv. Word coming in now that FTX co-founder Sam Bankman-Fried is back in a Bahamian prison after a hearing that was supposed to focus on his extradition. News reports had said he would waive his right to object to the extradition, but that's apparently not what happened. If you're trying to buy kids' pain reliever, good luck. CVS and Walgreens limiting purchases of kids' pain-relieving medicines because of shortages. And what's the smallest salary you would accept for a new job? Well, the Federal Reserve has been asking people that question for the past 8 years, and it is now at its highest, $73,700 a year, guys, as the pandemic and inflation contribute to rising salary demands, especially from people who would need to quit their current job for another one. Global news, 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Denise Pellegrini. This is Bloomberg. Scarlett, Katie, back over to you guys.
Thank you so much, Denise. And of course, Denise set us up perfectly with what's been going on in Washington. So let's check in with Joe Matthew, who is host of Sound On Bloomberg Radio. And Joe, you were at the hearing where the House committee made its recommendations. What was the mood like? Was it pin drop silence when they drew their conclusions?
It was through the whole thing, actually. You know, when the lawmakers walked in the room, and there's this sort of feeling of something, you know, very important about to happen here. You might agree with it. You might be a Trump supporter, but this is history. And seeing Benny Thompson and Liz Cheney set this all up, going through the video and bringing us back to that day on January 6th with some very difficult to watch video and testimony. leading up to the vote to refer criminal charges, pretty remarkable. It's never happened before. Not only has a president or a former president never been charged, Congress has never tried this, to refer criminal charges for one. I will mention that at the end of this, at the conclusion of the voting, Benny Thompson says, please remain seated as members of the committee leave the room. There was applause. That is not something that we're used to in Washington in congressional hearings. And I'll assure you, it wasn't coming from the reporters, the media stands. It was the rows of people in the back of the room who simply came to watch.
And so, Joe, I know you're going to get into it all over the next hour, but what happens now? What should we be watching for next?
Well, what the DOJ does, we have to remember that this committee got a lot of attention through primetime hearings and so forth, a lot of news, and they did gather an enormous amount of information. That's something that we could all watch and kind of get our arms around. But the Department of Justice is way down the road in their own investigation, and they don't talk publicly about that. And of course, we have a special counsel assigned to that case as well. So the question is, will this inform DOJ, and will DOJ, in fact, indict Donald Trump at some point in the months ahead?
Quick question, Joe, does Merrick Garland make this decision?
Actually, the special counsel is there just so Merrick Garland will be removed from it. They want to keep that sort of line between the administration and what happens here, and here we have a tough job for the counsel.
All right, Joe Matthew, thank you so much. Joe Matthew is host of Sound On Bloomberg Radio, and of course you will be hearing from him pretty soon. That does it for Bloomberg Business Week. I'm Scarlett Fu.
I'm Katie Greifeld. We're going to see you tomorrow. Scarlett, you're going to be here, right?
Yes, the two of us are reunited. We're filling in for Carol Masser and Tim Stanovic.
This is Bloomberg.
Very good morning and welcome to Daybreak Australia. I'm Heidi Stroud-Watts in Sydney.
I'm Annabelle Trawlers. We're counting down to Asia's major market opens.
Good evening from Bloomberg's world headquarters in New York. I'm Sherry Yan. The top stories this hour. U.S. stocks dropped for a fourth straight session as traders assess the Fed's path next year. Investors also awaiting the BOJ decision for clues on its plans as Governor Kuroda's tenure draws to a close.
Twitter users vote for Elon Musk to step down as CEO in a poll that the billionaire has pledged to respect.
And the January 6th House panel recommends Donald Trump face criminal prosecution for his role in the U.S. Capitol assault. This was a picture across Wall Street. We had the S&P 500 under pressure at one point, falling as much as 1.4%. We're talking about those consumer discretionary stocks leading the declines. We had Tesla rallying on news that CEO Elon Musk would step down, but that really faded throughout the session as well. So we really didn't have a lot of momentum in today's session when it comes to positivity, especially given that we also had data today showing that U.S. home building sentiment sank in December to the lowest in over a decade, excluding the time during the pandemic. Really not surprising given how high mortgage rates are, not to mention, of course, input costs continue to rise. We had the 10-year yield at around that 360 level. We had really treasuries falling, UK gilts falling. Of course, it's all about the Fed rate hike path, not to mention that there's been a lot of speculation whether the BOJ would actually carry out a hawkish pivot. So that's really affected the global bond market sentiment. We had a little bit of a rebound in oil prices despite that broad risk-off sentiment. But of course, you have to put this into context. We're still headed towards a second monthly loss for oil prices, Belle.
Yeah, Sherry, we're very much looking to take those cues for the Asia setup from what happened in the Wall Street session. So we've got most futures pointing lower now. Kiwi stocks already online in the red. Of course, you just mentioned what we've been reporting on with the BOJ, this possibility that the Prime Minister, Fumio Kishida, could add a little bit of flexibility to the central bank's inflation target. And that has been something really moving stocks as well in Japan. If you just take a look at this ticker, which shows Japanese bank futures, they're actually one of the very few that are in the green today. But still, Japan's top spokesperson, he says that no decision has been made on that, and we have been watching those fluctuations in the yen Off that, it is now trading flat. We could, of course, see more moves today with the BOJ meeting due. If you bring up this terminal chart, no change expected in rates, but still we are seeing a lot of international fundies preparing for a possible surprise here. So this chart taking a look at the 10-year yen swaps, and you can see they've been really surging well above that 0.25% line in the sand that is set by the policymakers in Japan. So popular